MM's arbitrage model, MM's arbitrage model. So we are given a very good illustration. Number of ordinary shares, we have 150,000 for those two respective companies. We have market price per share 1.2, we have 1. We have 6% debentures. X is evidently here levered. Of course, Y nothing. We have profit before interest, 18,000. Of course, you can take it as profit before interest and what? Tax, because the question doesn't have tax at all. So 18,000. Then, of course, this profit and is distributable as dividends. So they want us to do something very easy here. Using suitable calculations, demonstrate how under Modigliani and Miller approach without taxes, an investor holding what percentage? 10% of X will be better off switching is holding to beta limit, to Y limited, to Y limited. So in this case here, we have an investor who has 10% of X. We have an investor with 10% of X. So we are being asked whether he would be better off switching over to Y, switching over to Y. Oh yeah, this is a very easy question. Low-hanging fruits. Where are our low-hanging fruits here? Low-hanging fruits. Where are they? The camber fruits, we harvest them. Where are they? The low-hanging fruits, you're right. In this case here, we should start by getting the EPS of each company. Earnings per share of each company. So for me to be able to get earnings per share of each company, what do I need to do? I need to take EBIT minus interest, and then when we are given tax, we need to come and tax this thing. It becomes profit after tax. Now, could you kindly do me a favor? What amount will company X pay as interest? Interest of X. This will be 6% of 60,000. 6% of 60,000, because the loan here is 60,000. The rate of interest is 6%. The rate of interest is 60%. 6%. So 6% of 60,000. What figure are we getting? Somebody to help me answer layer there, or rather teach somebody. 6% of 60,000. This is 3,600. Thank you very much. And therefore, for this company X, EBIT minus interest into 1 minus tax for company X. EBIT, I can see earnings before interest and tax, 18,000. Minus interest of 3,600. Okay? Into 1 minus tax. In this question, what is the tax given? Tax given there is 0. No tax has been provided. So can somebody in this case here give me this distributable dividend, distributable earnings. So according to John Massey, according to Emily, we have 14,400. Thank you very much. So this is company X, basically. This is company X here. Now, these are the total earnings. So you're saying there the total earnings of the company, we have 14,400 like that. And we know the number of shares that the company has. So please go ahead and give us the earnings per share. Give us the earnings per share for company X. It will be the total earnings, the profit after tax, divided by the number of ordinary shares. So we have 90,000 like that. So could you kindly give me this EPS? Give me this earnings per share. Earnings per share. How much are we getting here? Earnings per share. earnings per share, we have here 0.16. We have 0.16. We have 0.16. We have 0.16. 0.16. Now, ladies and gentlemen, I would want you guys to do me a favor. Remember, currently, we have an investor. An investor who has got how many shares in X? We have got an investor with a good number of shares in X. We have an investor here. 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 The investor has 10% of company X, 10% of 90,000. 10% of 90,000, which gives me 9,000 shares, which gives me 9,000 shares, which gives me 9,000 shares. And therefore, this gentleman will take home how much as dividends? He has 9,000 shares and each share is earning 0.16. His dividends, the way things are, his dividends will be how much here, somebody? His total earnings, his total earnings, his total earnings, which is the same as total dividends, total dividends, total dividends, total dividends. It will be 9,000, 9,000, 9,000. We know that each share is earning him 0.16, and somebody has already given me the figure of 1440 like that. Could you kindly, in this case here, double underline this? Kindly double underline this, double underline this, kindly double underline this. This is very important. Somebody should be able to help Lucy there and tell them that the question you are doing here is here. Just a question from Muindi's, from the Muindi's YouTuber. Yeah, so 1440 like that. 1440 like that. Great. So what do you think will happen to this ninja? If this ninja now moves straight away to Y, what are some of the things in this case here will you be looking at? If this guy, I'm calling him a ninja, who has 10% of X, if he decides to make a move, you as an investor, you as a finance student, what? Yes, the proceeds, because he's going to sell his shares. So if he switches to Y, if he switches to Y, he's going to sell shares. So come here and give us the proceeds. Right? So in this case here, we have from sale of equity, cash from sale of equity. From sale of equity, remember, these are our shares, the shares of this ninja. This ninja has got how many shares of X? 9,000, and each share currently is going for 1.2. So then 9,000 times 1.2, this guy will get how much? Cash from sale of equity. John Massey tells me that this will be 10,800. 10,800. 10,800. And then I remember that this is a two-legged question always. That he can't only take equity to company Y. Would want the two companies to be the same in terms of risk, right? Would want the company to be the same in terms of what? Yeah, in terms of risk. So remember, it is equity and debt. This is quite confusing, but it's something you can always know. It's something you can always know. So when you talk of cash from sale of equity, also remember that there is in this case here, debt instrument. There is the borrowing concept. There is the borrowing concept. And this borrowing, I would want you to listen and listen to me very carefully. This guy himself now has to behave like company X. He'll ask himself, how much does X have in terms of what year? Total debenture. X in totality, it has 60,000 loan. But now remember, myself, I'm just having a 10% of the shares. So everything of mine should be 10%, 10%. Right? Remember, his shares are what percentage? 10%. So therefore, he can only borrow 10% of the company's debt. 10% of the company's debt. So 60,000 times 10% gives me what figure? Somebody here. Gives me what figure? Somebody here. Gives me what figure? Somebody here. Somebody tells me that this is 6,000. And therefore, the total cash will be taken and invested in company Y. The total cash will be taken and invested in company Y. So in this case here, what is the total cash? What is the total cash here? What is the total cash going to company Y? What is the total cash going to company Y? Total cash going to company Y, abracadabra, when you add the two, you are getting 16, you are getting 16,800, isn't it? You are getting 16,800. This is the total cash now going to Y. Now I'll come and address, write a big thing here. Talk about company Y. Come here. So company Y. So company Y. So company Y, the first thing that I will look for under company Y is the earnings per share of company Y. That is where I will start from. The earnings per share of company Y. Is there somebody who is able to give me this earnings per share of company Y? Earnings per share of company Y, according to John Massey, it is 0.12 EPS. Thank you very much. John Massey has appreciated that EPS can only come from this thing. It is EBIT minus interest into what here? Somebody 1 minus taxation. So this basically will be your profit after tax. So ladies and gentlemen, EBIT for company Y, I can see this profit here, EBIT is 18,000. Company Y doesn't have any debt. Company Y does not have any debt. So debt here is 0. Remember that our taxation is 0. Tax has not been provided. Taxation is 0. Taxation is 0. So is there somebody who can give me this profit after tax? Is there somebody who can confirm that the profit after tax is 18,000? Is there anybody who is able to confirm that the profit after tax there is 18,000? I can see Jackie Onchola. David, thank you very much. 18,000. Now, ladies and gentlemen, once I get this, I know how to calculate EPS. It is profit after tax, which is 18,000. And then I will be able to come here and divide this by the nose. The number of ordinary shares. Number of ordinary shares of company Y in Ngape. Number of ordinary shares of company Y in Ngape. 150,000, isn't it? 150,000. Therefore, each share, ladies and gentlemen, each share in this case here will give us what earnings? What is the earnings per share? What are the earnings per share? What are the earnings per share? So they're saying it is 0.12. Thank you very much. Some 1 minute to breathe a little bit. And as we breathe, can somebody in this case here be forward thinking and advise us really? What do you think will be the next thing now we should do in this question? What do you think should be the next thing we should do in this question? Buy shares in Y. Buy shares in Y. Buy shares in Y. Buy shares in Y. Remember this investment. Thank you very much. Investment. 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 By the ninja. By the ninja investor. By the ninja investor in Y. This guy is taking 16,800. Then how many shares? Number of shares of Y to be bought. Number of shares of Y to be bought. Number of shares of Y to be bought. Zitakuwa ngapi? This ninja. The ninja. I can see John Massey has the other method, which is still good enough. But let's learn something new today. Number of shares that will be bought by Y using this ninja. The investment by ninja is giving us 16,800, which he got from the previous transaction, right? So remember, these are Kenya shillings or whatever. These are Kenya shillings. So I would want to know, armed with the Kenya shilling 16,800, how many shares will he be able to buy in Y? How many shares will he be able to buy in Y? Remember that one share in Y equals 1 Kenya shilling. Equals 1 Kenya shilling. How about 16,800 Kenya shillings? How about this? When you cross multiply, you can see so many of them are telling me it is 16,800 shares, 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 16,800. So this ninja will get 16,800 shares in a company Y. Is that okay? Is that okay? Is that okay? Is that okay? So then what do you think will be his total earnings? What do you think will be his total earnings? What do you think will be his total earnings? Now that we have these 16,800 shares, what do you think? What is the earnings per share of company Y? What is the earnings per share of company Y? Earnings per share of company Y. Earnings per share of company Y. Wameshasahau earnings per share. So total earnings, allow me to call him a ninja, but don't use that word in an exam room. Don't use that word in an exam room. So in this case here, total earnings of ninja here from Y. From Y, it will be 16,800 times the earnings per share, which was 0.12. Was it 0.12 or 1 point? Yeah, 0.12, 0.12, which Mary is giving us as 2016 like that. But now remember, as he's enjoying these total earnings from company Y, he did some personal borrowing. Do you remember he borrowed from some place? Do you remember he borrowed from some place? Yes. How much? They're forgotten. They're forgotten. How much did he borrow? How much did he borrow? 6,000, yes. So in this case here, less interest on personal debt. On personal debt. Less interest on personal debt. The personal debt is 6,000. So I should take 6,000 times what rate of interest? 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 How comes I'm only talking to gentlemen alone today? Today, there's no lady who wants to talk to me. I don't know why. 6%, 6%. So 6%. So could you kindly subtract here? 6% times 6,000 gives me how much here, somebody? 6% times 6,000 gives me how much? 360. So could you kindly subtract here to give me the net earnings receivable by the ninja? Net earnings. To give me the net earnings receivable by this ninja. Net earnings is 1656 like that. So where is he better off? Where will you advise this ninja to go? Will you advise this ninja to remain in X or to switch? To remain or switch? Remain or switch? Switch to Y. And if he switches to Y, then he's going to make some premium. He's going to make some profit. That profit which is realized by the switch is what we call the arbitrage profit. Is what we call the arbitrage profit. So we have here arbitrage profit. The arbitrage profit will be 1656 minus what he was getting in this other company. 1656 minus how much was he making from this other company? 1440. 1656 minus 1440. If you do it that way, then you'll be able to get an arbitrage profit of how much? Arbitrage profit of how much? Of 216. Of 216. Ladies and gentlemen, in an exam situation, you may not be able to make like all the marks out of, you may not be able to get like all the marks in this question. But I strongly believe that a good student, if you're given like 8 to 10 marks in this kind of a question, a good student should be able to get more than 4. Because they are similar, all of them. Those questions are similar, all of them. They're similar, all of them. The only thing that I would want to twist you a little bit in is to give you a tax rate. Give a tax rate of, say, 30%. Give you a tax rate of 30%. Now, ladies and gentlemen, I would want you to do me a favor. I would want you to do me a favor. I would want you to do me a favor. Like they asked us in this question, ladies and gentlemen here, they asked us here, Explain when, according to Modigliani and Miller, without taxes, the process described in B above would come to an end. What will happen, ladies and gentlemen, is that for this company that is overvalued, right? Because of looking for opportunities elsewhere, so many people will start selling their shares in this company. So they start selling their shares, many people start selling their shares in this company, there will be an oversupply of the shares of this company at the stock exchange. And if there is an oversupply of these shares at the stock exchange, automatically the price will go down, right? And of course, as many are coming to demand for these company shares, the price is going up. So this will keep on coming down, right? This coming down, the price coming down. The other one is going up. At some point, they will reach what we call an equilibrium. And this is why this answer, ladies and gentlemen, reads this way. The process described above, the one of arbitrage gain, will come to an end when the value of the overvalued firm comes down to equilibrium. As investors sell shares of the overvalued firm in order to buy shares of undervalued firms, the market value of levered firm will come down to equilibrium, where both firms will command the same value, where both firms will command the same value. So I'm repeating this again for the umpteenth time. We are saying that at the end of the day, this is the better firm for now. And because it is the better firm, it is the one that is overvalued, what will happen, ladies and gentlemen, investors are bright. They know that overvalued firms, at the end of the day, in the long run, they'll become loss-making, right? So they know that today they are getting kind of a premium, right? So for instance, what do you think of farmers right now in Rift Valley who don't want to sell their maize? Are they risking anything or are they better off? Yeah. So if you ask me right away, the moment we hear that this GMO, whatever is wherever, or somebody is bringing these things from Mozambique or wherever, and they have docked at some port of entry, I'll straight away mention that this thing is what is over. I can see that value coming down. So then what do you do if it's an overvalued organization? You're always better off selling the shares immediately so that you can go to now smaller farms with a better future. Smaller farms with a better future. So what will happen? Because everybody will be running away from this company here, right? The share price, because of the oversupply over the company shares at the stock exchange, the share price will go down, right? It will go down like that. And then at the end of the day, it shall be able to equate to the share price of this other company, which is called what here? Equilibrium point. So ladies and gentlemen, the most important thing is that you guys have been able to pick this in a way that you can try to explain it in an exam, even if it is in your own mother tongue. At least you have a point. You'll not be very green. You'll not be very green in that exam. Now, when you look at part 1 of this question, November 2017 question 4, November 2017 question number 4A, November 2017 question number 4A, 2 CPA graduates. It's about indifference points. 2 CPA graduates, are we there? Are we there? Somebody, 2 CPA graduates, are we there? Are we there? Thank you very much. We are told that 2 CPA graduates have formed a company to come and compete with us, to come and compete with RSM publishers. 2 CPA graduates have formed a company to write, market, and distribute textbooks and revision manuals. The company's textbooks and revision manuals have already been piloted and the market prospects are good. All that is lacking is adequate financing to continue the project. A small group of private investors is interested in financing the new company. 2 financial proposals are evaluated. We are told here financing option 1. This is an all equity capital structure. 3 million shillings would be raised by selling ordinary shares at 40. You know, if you're a bright student, I don't even have to finish reading this thing. Instead of being in that exam room and your work is only to look at the ceiling, I mean, I can easily calculate the number of ordinary shares here. Gazing at the ceiling can never be my portion. I need to overcome this. The moment I can see an amount of 3 million and I know one share is going for 40 bob, can somebody give me the number of shares to be bought there? How many shares? How many shares will we issue for us to be able to get the 3 million? Somebody. Right. I can see Jackie Ochola giving me 75,000. Yes. Because you see, I want to earn 3 million shillings. And one share will only earn me 40 bob. So then how many shares will I sell to be able to earn 3 million? Cross multiplication. Thank you very much. That can give you 1 mark, and 1 mark to us can make you see places that you have never seen before. Financing option 2. This will involve the use of financial leverage. 1 million shillings would be raised by selling corporate bonds with an effective rate of interest of 14% per annum. The remaining 2 million would be raised by selling ordinary shares at 40 each. So if I'm the one, here I'm seeing a two-pronged way of raising the 3 million. The first one is that I'm going to give out a debt instrument and earn how much? 1 million. Whenever I see debt, a good student of finance will always think about interest. Option number 2. Option number 2. Option number 2. So for option number 2, what do we have here for option number 2? So for option number 2, what I can see here straight away for option number 2, 3 marks for option number 2, I can see debt, I can see equity. So for debt, I can see 1 million. Therefore, the interest, they have told you it's 14%. So 14% of 1 million gives me how much in terms of interest? 14% of 1 million. Interest on bond, yes, it's 140,000. Thank you very much. Remember, in total, these guys need 3 million to be able to come and compete with the Aura here. They need 3 million. So meaning that the 2 million will be raised by themselves, They'll have to buy shares of the companies, And each share goes for how much? Each share is going 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 for how much? Can somebody 40 bob? So please come and divide this by 40 for you to be able to give us number of ordinary shares. Of which they're telling me it is 50,000. They're telling me it is 50,000. Thank you very much. How comes you're not complaining about speed nowadays? Is it because you are now used to watching videos at the speed of 1.5? Great. We shall overcome. We shall overcome. We shall overcome. We shall overcome. Great. Great. Now, ladies and gentlemen, once I'm here, I'll be able to remember this concept of indifference. I'll be able to remember this concept of indifference point. I would always be indifferent if 2 options are equally profitable. Being indifferent is sitting at the fence. There is one time, although nowadays this guy is very nice, there's one time when Kalonzo Musyoka was being called a watermelon. Do you know why he was being called a watermelon? He was so indifferent. He was not able to make a decisive decision that I want to be in this camp. He used to jump here and there quite a lot. So when you're indifferent, ladies and gentlemen, you are not decisive. You want to sit at the fence. And you want to sit at the fence, not that you are a madman. It's because, ladies and gentlemen, you are basically like an hyena here who is saying this road is good, this other road is good, and you want to follow both. Right? So you're sitting right at the fence because the 2 roads are equally profitable. The two roads are equally profitable. They're equally profitable. Now, listen to me very well. So anytime you hear of an indifference point under financing decisions, I would want you to write the EPS formula like this. EPS formula under indifference points. EPS formula under indifference points. EPS formula under indifference. EPS formula under indifference. EPS formula under indifference. This EPS will be equal to EBIT minus interest into 1 minus taxation minus preference dividends, and then everything to be divided by your nose. Everything to be divided by number of ordinary shares. Number of ordinary shares. Okay, so in this case here, we have to give people 3 minutes, actually, 3 minutes, 3 minutes. So shall come back at exactly 9. Thank you. Now, so what we shall do first of all is to get EPS of option 1. Remember, under option 1, you told me that is 0, and therefore interest is 0. Yes, John. John is asking, is interest taxable? I thought we subtract first before taxing. Yes, if you follow this body mass, it means that interest is tax allowable, right? The one that is not tax allowable can never be under this bracket, like preference dividends cannot be taxed. Also, you're putting preference dividends outside tax bracket. If I'm getting your question, John, clearly. Again, John, right now, it's not really even about logic. Right now, it's about you mastering some concepts that can make you to survive. When you become members of this pack, I'll be able to teach you guys these things deeply. For now, it's survival for the fittest. So in this case here, under option number 1, number of ordinary shares, you gave me 3 million divided by 40. So if I remember very well, you guys gave me 75,000. You gave me 75,000. Number of ordinary shares, 75,000. So if that is the case, could you then kindly come here and give me EPS of option 1? So EBIT normally is never known. Interest, you've told me, is 0 times 0.7. Preference dividend is 0. Number of ordinary shares are 75,000. I'm so sure that most of us have not seen where Mwalimu got 0.7 from. Most of us have not seen where Mwalimu got 0.7 from. Do we know where Mwalimu got the 0.7 from? Do we know where Mwalimu got the 0.7 from? Yes, it's 1 minus tax. Tax is 30%. So 1 minus 30% gives me 0.7. I can see Mayomi is already ahead of us, which is very good. Which is very good. So please go ahead and give us this EPS 1. Go ahead and give us this EPS 1. So the EPS 1, if I take this, it will be 0.7 EBIT all over 75,000. And then you block it like that. You block it like that. That's EPS. It should come as an equation. Remember, under indifference points, you don't know EPS and you don't know EBIT. You don't know EPS and you don't know EBIT. Remember, those are the things you're looking for. So if you allow me, I'll straight away now go to option number 2. Option number 2 is the one that you guys gave me a few things. Option number 2, what do we have here under option number 2? Under option number 2, ladies and gentlemen, we have here debt. You told me that debt is 1 million. And then you told me that interest is 140,000. And then you told me that equity, if I remember very well, equity was 2 million, giving us number of ordinary shares of 2 million divided by 40, which gave us 50,000, So then using option number 2, are you able to give me EPS 2? Is there somebody who can give me EPS 2? If you plug in these figures in the formula, EPS 2 will be equal to EBIT minus interest of 140,000 times 0.7, preference dividends hakuna, divided by 50,000, divided this by 50,000. Please let me know whether we are together up to here. Let me know whether we are together up to here. Thank you so much. Thank you so much. Thank you so much. Thank you so much. So then go ahead and open brackets for us. Go ahead and open brackets for us. Go ahead and open brackets for us. When you open brackets here, when you open brackets, what do we have here? EPS2. EPS2 will be equal to this 0.7 will knock against each of these. So we can give, what is 0.7 of 140,000? What is 0.7 times 140,000? What's 0.7 times 140,000? Oh, yeah. According to John Masi, Jackie Ochola, Saimo Devi, wananiambia mwalimu 98,000, 98,000, 98,000 divided by 50,000. Okay. So then remember what they have asked us now to do. What have they asked us to do here? They wanted us to find the operating profit indifference level associated with the two financing plans. So we know that at the point of indifference, this is what we know. At the point of indifference, 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 EPS1 must always be equal to EPS2. And the EPS1, we know it. EPS1 is 0.7 EBIT all over 75,000. This formula here equals 0.7 EBIT minus 98,000 all over 50,000. Yes, at the point of indifference, the two EPSs must always be the same. Which reminds me that little song we used to sing when we were little men, boys. Parachichi, parachichi, tiki tiki maji, yote ni matunda, yote ni matunda, right? So at the point of indifference, ladies and gentlemen, nimesahau kitu katikati hapo. At the point of indifference, EPS1 should be equal to EPS2. So you equate the two formulas. You equate the two formulas. So in this particular case, come and cut these 3 zeros like that. Make it easier like that. Cut those 3 zeros. Cut those 3 zeros like that. Cut those 3 zeros like that. So if you cross multiply, this will be 0.7 EBIT times 50 equals 75 comes here. 75 into 0.7 EBIT minus 98,000. So ebu enda pole pole hapo niambie. Ebu saidia mwalimu. What is 50 times 0.7? What is 50 times 0.7? What is 50 times 0.7? 35, eh? So 35 EBIT, thank you very much, equals, how about this 7? I want to distribute this 75. What is 75 times 0.7 EBIT? 75 times 0.7 EBIT. That gives me what figure? 75 times 0.7. 52.5, I'm being told. 2.5 EBIT. Minus, what is 75 times this 98,000? 75 times 98,000. 75 times 98,000. What figure do we have here? 75 times 98,000. Yeah. So in this case here, 75 times 98,000 gives us what figure? 73,50,000. 73,50,000 like that. Now from there, ladies and gentlemen, please come and take this here. On their side, it will be negative, isn't it? It will be negative. So it will be 35 minus 52.5, which will give us what figure? Somebody, if you are following. Somebody, if you are following. So minus 17.5 EBIT should be equal to minus 73,50,000. So meaning that EBIT at the end of the day will be equal to who? If you divide, if you take this divided by this, is it 17,500 or 17.5? I don't know. I don't know. 420,000. You guys are the ones who are giving me these figures. So EBIT at the point of indifference is 420,000. EBIT at the point of indifference is 420,000. How about EPS at the point of indifference? How about EPS at the point of indifference? EPS at the point of, already we have the equations of EPS. You plug in anywhere there. 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 So come here and give us, come here and give us EPS. Are you able to see Mwalimu now? Are you able to see Mwalimu now? Are you able to see Mwalimu now? Are you able to see Mwalimu? Ah, great, great. Thank you very much. Great. So then if you use this formula, it will be 0.7. EBIT you have given me for 20,000 over 75,000, which then will end up giving me what figure, somebody? So EPS, I'm being given a figure of 3.92. EPS is 3.92. Thank you so much, 3.92. Thank you so much. Thank you so much. Thank you so much. Great. And I'm so sure that all of us in an exam situation would have gotten all those marks. So the thing is, have you gotten some, you know, you don't have to understand really everything. Where we have reached right now, it's about harvesting low-hanging fruits. Have you been able to get some concept that can allow you to like even get 3 out of 7? But what I don't want is a situation where my students are getting 0. No, 0 you don't want. 0 you don't want. 0 is very, very, very bad. We should be able to get more than half. Should be able to get more than half. So then here, they wanted us to draw a graph, which I feel that I should not draw for you. Do you want me to draw? Is it a must I draw that graph for you? Is it a must for me to draw that graph for you, really? Is it a must for me to draw that graph for you? I feel I should not draw it for you.